Picture two gym rivals who've been flexing on opposite sides of the room for years. One's the cardio king, endless stamina. The other's the powerlifter, can move mountains. Then one day they fist bump and say, "Want to win the decathlon together?" That's basically today's headline. NVIDIA and Intel just announced they'll co-build multiple generations of chips for data centers and PCs, and NVIDIA is also buying $5 billion of Intel stock. Think LeBron teaming up with Steph, plus buying a piece of the Warriors. Wild, right? There are three big moves. Firstly, the strategic alliance. Intel will manufacture custom x86 CPUs that NVIDIA will plug into its AI systems for the cloud. Translation: NVIDIA, the current MVP of AI, gets CPUs tailored for its playbook, while Intel gets relevance inside the fastest growing segment of computing. There are three big moves. Secondly, PC superchips. Intel will sell new PC chips, x86 RTX SoCs, that fuse Intel CPUs with NVIDIA RTX graphics chiplets. Think of it like a laptop brain that speaks both productivity and gaming AI natively. Thirdly, equity check. NVIDIA is putting $5 into Intel stock at $23.28 per share. That's not charity. It's a financial and strategic signal. We're aligned, we want influence, and we want upside if this works. From a corporate finance angle, this is a mashup of make versus buy. Instead of building its own x86 CPU franchise, NVIDIA buys access through Intel. Strategic investment, minority stake, to align incentives without the baggage of a full acquisition. Ecosystem play, tighter integration between CUDA, NVLink, NVIDIA's software-hardware stack, and Intel's gigantic x86 world to reduce friction for customers. Why should you care? Because value in semis isn't just about faster chips. It's about integration economics, better performance per dollar, lower energy per workload, and less complexity for big buyers, clouds, enterprises, PC OEMs. If integration improves those unit economics, total addressable market, TAM, and pricing power go up. If not, it's just a shiny press release. Analogy: imagine running a massive delivery service. You've got trucks, CPUs, and turbo drones, GPUs. Today, you buy trucks from vendor A and drones from vendor B, then spend a fortune on adapters, routing, and fuel. NVIDIA plus Intel are saying, we'll co-design the trucks so the drones dock perfectly, share batteries, and talk the same language. Fewer adapters, more packages per hour, lower cost per delivery. That's how hyperscalers and enterprises think, cost per unit of work. Now connect this to CrowdStrike's stock jumping. CrowdStrike sells cybersecurity as a cloud platform. Think security drones watching your network. The stock ripped because management just laid out stronger than expected targets, more long-term growth in annual recurring revenue, ARR, and solid margin ambitions, at around their big event. When a company with sticky subscriptions tells investors ARR will grow 20% plus and margins improve, Wall Street can model higher cash flows and a better Rule of 40 profile. Price moves follow the math. See the rhyme? NVIDIA plus. Intel are pitching integration to unlock performance and cost advantages. If customers buy it, revenue mix shifts toward higher value platforms. CrowdStrike is pitching visibility and durability of cash flows, ARR margins. Investors reward predictable, compounding unit economics. Both stories are really about financial plumbing underneath the tech, integration that lifts throughput, NVIDIA, Intel, and subscriptions that lock in cash, CrowdStrike. What the market is also thinking: risks and second-order effects. Execution risk. Co-developing multiple generations of chips is hard. Roadmaps slip. Packaging and chiplet integration are non-trivial. If schedules miss, that $5 stake looks less strategic, more oops. Supplier politics. NVIDIA still relies heavily on TSMC for manufacturing advanced GPUs. This deal doesn't erase that. Expect questions about who builds what, on which node, and at what yields. If Intel Foundry isn't central here, The collaboration helps Intel's CPU platform story more than its foundry turnaround. Yes, that nuance showed up in early coverage. Channel conflict. AMD isn't going to sit still. If Intel leans into NVIDIA on PCs, what happens to Intel's own ARC graphics or to OEM dynamics? Strategic alliances can squeeze other partners, and they notice. For CrowdStrike, great guidance raises the bar. After last quarter's wobble around near-term revenue outlook, today's optimism resets expectations. If net new ARR or margins miss later, the stock can snap back. Subscriptions compound up and down. Now a quick finance translation: how to read announcements like this follow the incentives. A minority equity stake aligns behavior without the cost of control. It's a call option on the partnership's success. NVIDIA's 5B Carmi skin in the game. Model the unit economics. Will integrated CPU plus GPU platforms reduce cost per AI workload for big buyers? If yes, pricing power and share shift can expand gross margin dollars. Watch the KPIs. For NVIDIA, Intel. Design wins, benchmarks, attach rates in PCs, and cadence of next-gen launches. For CrowdStrike, net new ARR growth, retention, NRR, operating margin, and free cash flow. Those are the gears that move valuation. Two rivals just teamed up to make the AI PC stack snap together like Lego, and NVIDIA backed it with a 5B check. If integration delivers better performance per dollar, that's real value creation, not just vibes. Meanwhile, CrowdStrike reminded investors why subscriptions are powerful. Credible long-term ARR plus margin targets turn uncertainty into spreadsheets, and spreadsheets into higher stock prices. In one line, tech headlines thrill, but finance fundamentals pay the bills. Follow the incentives, model the unit economics, and let the KPIs tell you who's actually winning. And if you want more finance explained without the boring jargon, hit like, hit subscribe, and we'll keep breaking down billion USD or Euro moves into plain English.